Gross domestic product, or GDP, is a vital term in economics. It represents the total value of all goods and services produced within a country over a specific time period. A high GDP indicates a strong economy, while a low GDP can signal economic trouble. Understanding GDP helps gauge the economic health of nations. It affects job creation, investments, and public spending. Governments and policymakers closely monitor GDP to make informed decisions. Let's dive in and break down the components of GDP to make it easier to understand. By the end, you'll know why GDP is important and how it impacts the stock market. GDP stands for Gross Domestic Product and measures a country's economic output. It calculates the total value of all finished goods and services produced within a country's borders in a specific time period. GDP serves as a comprehensive scorecard of a country's economic health. Governments use GDP data to design economic policies and strategies. It helps investors make informed decisions, as a growing GDP generally indicates a thriving economy. GDP also plays a critical role in comparing the economic performance of different countries. It influences employment rates, inflation, and the standard of living. A high GDP often correlates with better job opportunities and higher wages. With this foundation, let's move on to the methods of calculating GDP. There are three primary methods to calculate GDP: the expenditure approach, the income approach, and the production approach. The expenditure approach adds up all expenditures made in an economy, including consumer spending, business investments, government spending, and net exports. The income approach calculates GDP by adding up all incomes earned, including wages, profits, rents, and taxes minus subsidies. The production approach adds the value of all goods and services produced, subtracting the value of goods and services used up in production. Each method offers a different perspective but arrives at the same GDP figure. GDP comes in different forms: nominal GDP, real GDP, and per capita GDP. Nominal GDP measures the value of goods and services at current market prices without adjusting for inflation. Real GDP adjusts for inflation, providing a more accurate reflection of an economy's size and growth over time. Economists often prefer real GDP for comparing economic performance over time. Per capita, GDP divides the total GDP by the population, giving an average economic output per person. This helps to understand the standard of living. A higher per capita GDP indicates a higher standard of living. By understanding these different types of GDP, we can get a clearer picture of a country's economic health. Next, let's see how GDP impacts stock markets. GDP has a significant impact on stock markets. A growing GDP often leads to bullish stock markets as higher economic output translates to higher corporate profits. Investors closely watch GDP reports to gauge the health of the economy. Positive GDP growth boosts investor confidence, leading to more stock purchases and higher prices. Conversely, a declining GDP can lead to bearish markets as investors become wary of economic downturns. GDP growth also influences central bank policies such as interest rates. Higher interest rates can slow down economic growth and impact stock prices. Thus, GDP is a crucial indicator for stock market investors. By understanding GDP trends, investors can make better financial decisions. Now let's look at some real-world examples. Let's consider some real-world examples to understand the impact of GDP on stock markets. During the 2008 financial crisis, GDP plummeted, leading to a sharp fall in stock markets. From 2010 to 2020, countries like the US and China saw steady GDP growth. This was reflected in stock markets with significant gains. The COVID-19 pandemic in 2020 caused a dramatic fall in global GDP. Stock markets initially crashed, but some sectors rebounded quickly. These examples show the direct correlation between GDP and stock market performance. In conclusion, GDP is a critical measure of a country's economic health. It helps to understand the economic output, living standards, and overall well-being of a nation. By using various calculation methods, we can derive a comprehensive picture of GDP. Understanding the different types of GDP, nominal, real, and per capita, helps to get a clearer insight into economic performance. GDP significantly impacts stock markets, influencing investor behavior and market trends. Real-world examples further illustrate the importance of GDP in economic planning and investment strategies. By keeping an eye on GDP trends, individuals and policymakers can make better economic and financial decisions. Understanding GDP is crucial for anyone interested in economics, investments, or making informed financial decisions.